Hey guys, how's everyone doing? We're just gonna give it a minute or two before we get started. Nice to see everyone on here. Hi Yen. Hi Lucky, Maureen, Robert's on here, Rosie, Seth, Fennel, Loki. Nice to see everyone. Hi Recha. Awesome.
Hi.
Hi. How's everything going with you?
Pretty good, thanks. Happy New Year. How are you doing?
Good, good. Back stateside, I'm a little jet lagged, so caffeinated to make sure I get through the webinar, but otherwise all good.
Good.
Awesome. Hey Rosie, we're gonna get started in a little bit. Rachel, we'll just give it a minute or two, give others a chance to stream in. But for those of you on here, just in the chat, let us know where you're tuning in from. I feel like I know so many of you, but there are always so many new people in here. Hey Seth, hey Ruth, Moeed. Oh, hi Prakriti. How's 2026 treating everyone? Charleston. Awesome. Welcome, Fennel. Hi, Ruth. Ruth from Iowa. Hey, Rosie's from the Woodlands. Yes. This is this property is also Houston from Houston. So excited. I know we have a lot of people from Texas. Seth is from Sacramento. Venkat. Nice to see you on here. Okay, guys. In the interest of time, I guess we can get started. Um, Oh, yes. Hey, Maureen. Awesome. Thank you for that reminder. Nice to see you on here. Excellent, everyone. You closed a duplex this Friday. Oh my God, I'm so happy. I'm so happy to hear that. Maureen, guys, was our last year's Spring 2025 scholarship winner for our coaching program. She's also Houston-based, and she just co closed on her duplex this Friday. Curious, Maureen, is the duplex in Houston? Houston is actually a great market. That's my market where I cut my teeth, where I started my portfolio. Yes, yes, it makes absolute sense. And this is what usually if you're from one of those markets where the numbers make sense, it's a good market from a demographics perspective, makes absolute sense. So congratulations on that. That's a great start to 2026. Excited for you. Keep me posted how things go. That being said, everyone, I think we should just get started and people will keep streaming in. As always, guys, this is some of you are in our previous investments, and so this is a great opportunity to get started for 2026. Start tapping into those tax efficiencies, increasing your passive income. Some of you are new to the community and you may just be getting started. So we usually have a good mix of people in here. And I think that's the best part. What I try to do with this webinar, like other webinars, is I'll always try to be hyper focused on educating. And so if you're just getting started and you're learning, this is a great opportunity. We'll have tons of time for Q&A on the back end. Make sure you're dropping all your questions in the chat. If you're listening to this on Facebook, YouTube, do the same thing. Keep dropping your questions, and we'll get to it on the back end. And so they could be related to the opportunity or related to real estate investing in general. It could be specific to the real estate market, trends, anything. Guys, this is our chance to gather together, learn, educate ourselves. And so keep dropping your questions in. What I will do is I will go over the opportunity first. And I'm super excited about this. Again, this is our fifth property in Houston, and in line with everything we've done in the last year, we've always pivoted based on the market cycle and the economy. And again, this is again another great opportunity with high cash flow day one, which is very conservative, and it fits our buy box and. Not a lot of deals fit our buy box. We go through at least 20, 30 opportunities before we pick one that makes sense for us. And so I'm really excited to deep dive into the fundamentals. I'm excited to teach, educate. That's the goal of everything we do. So let's get started. And I'm really hoping to get to know a lot of you as we go through this. And remember, guys, real estate, we'll talk a lot about tax efficiencies, and there are nuances to it. So if you have questions specific to your portfolio and how this could play into your portfolio and be efficient from a tax perspective. Make sure you drop your questions in the chat, and we'll get to all of it. The agenda, for those of you who haven't been to one of our deal webinars, we'll start off by talking about the opportunity per se. And I like to run that in two separate segments. We'll talk about the returns, right? And like all our other opportunities, this is another deal where our investors, GW investors, get preferred returns, get higher returns than retail investors, both higher preferred returns, higher splits. I'm going to explain all of that. And then we'll talk about the tax advantages. And then I love talking about due diligence, right? And so there, I know a lot of you trust the community and you love investing with us, but I also want you to be able to do your due diligence. And so we always look at returns, but we also look at, the risk profile of an opportunity, how we've de-risked this, and how you should look at due diligence as you explore other opportunities this year with us, with other operators, right? So we'll talk about due diligence. Then we'll talk about the timelines for this opportunity and then next steps, and then we'll open it up to Q&A. And like I said, generic questions, questions about the market, questions specific to your portfolio, tax benefits, all of that. I'm here to support you guys. Now, that being said, you're going to hear some numbers during this presentation. Remember that these are all projected returns and there are no guarantees. We always say, I'll talk about how this fits into most people's portfolios. We'll talk about tax efficiencies, but always remember that, real estate investing, like everything, is very personalized. So please make sure you talk to your CPA and your attorneys before you make decisions. Yeah, with that disclaimer in place, let's move on. Now, most of you know me, and I know you really, really well. For those of you who are new to the community, I'm Param. I'm a radiologist in Southern California. I got to financial freedom using real estate at the age of 41, and that was after a rough career transition and realizing that I wanted to have more autonomy. And after that, I've been passionate about passing on the knowledge, and I went on to create the Generational Wealth MD community. We have about 20,000 physicians in the community at this point, and our goal is to help, professionals, high net worth individuals, and physicians really learn to personalize their portfolio and include alternative assets so they can accelerate to financial freedom, right? So that's a passion project for me. That's the mission of Generational Wealth MD. And then GW Capital was created because the majority of people in the community want to invest passively in opportunities. And it started when I had friends bring opportunities to me, make big mistakes, six, seven-figure mistakes. And GW Capital was created with the intent of really us going in as general partners on these opportunities, doing the due diligence and doing a lot of the vetting for you on the front end. But I would say overall, across both communities, a big part of the mission is also to educate and help all of you be able to make intelligent decisions, whether you work with us, you work with other operators, or you're building your own portfolios, right? And so you'll see that that's a theme throughout the presentation today. It is to educate and explain concepts. And if I rush past something and you want more clarity, feel free to drop the questions in chat, and I'll get to all of that on the back end. At this point, GW Capital, we have over 2,200 doors in management in partnership, and that's 570 million in real estate. And our goal with GW has always been to get our investors, and I feel like we've been really successful in the last year and a half to get our community higher returns than retail investors, right? And that's because we go in with a larger check size. We have the power of this large community where we invest together, right? And so we've always been able to negotiate higher returns for our investors. I'll show you how we've done that for this opportunity. Our goal is always to go into these opportunities where you get tax efficient cash flow hitting your bank account, right? So tax deferred cash flow, so you're not paying taxes on it. But the goal is also to get into opportunities, and we have to be specific about this because on the back end, the PPM has to be structured in a way where you are able to 1031 into another opportunity, and that keeps both your cash flow and your overall returns tax efficient, right? So that's a big part of what we are intentional about. We're intentional about going into really, really conservative opportunities and hyper focused on capital preservation. And I'll talk to you about how like other opportunities we entered last year, this is another opportunity that is very conservative, very much handpicked for the market we're in, and we'll talk about that business plan. But again, a big part of starting GW Capital Fund 1 2 years ago has been to give our investors that white glove experience, enhance your investor experience, and our investors get a single K1 end of the year. You could be in multiple deals with us. It's a flexible fund. You get to pick and choose the deals that the opportunities you enter in. You get to do due diligence on each of them, right? It's not a blind fund. You get to decide how much you put into it. But end of the year, we want you to get a single K1. It's almost like the Merrill Edge, right, for real estate syndication. So that's our focus. We've done, we've really been able to deliver as far as that goes. Our team, Tommy is not on here today. He had a prior commitment, but many of you will have conversations with him, or you've had conversations with him in the past. He is our investor relations associate, and then the rest of the team, Adrian's on here. Anthony, many of you will touch base with, and so we're all here to support you. At a glance, we've talked about some of these numbers. Our portfolio keeps growing. We have over 350 investors at this point. Our goal, if you want to take a look at our portfolio, if you go to gwcapital.com, you can take a look at our other assets. We've been hyper focused on having a very clear buy box and making sure we get into conservative opportunities in high growth markets while giving our investors enhanced returns. And I'd say when I talk about the overall mission of GW Capital, right? If I had to talk about Generational Wealth MD, everything that we do is to break barriers to investing in real estate, to investing in alternative assets that are non-correlated to the stock market, with the end goal of having all of our portfolios, mirror what an ultra high net worth, individual's asset allocation looks like, right? And so, like many of you, for the first decade that I was investing, I was primarily invested in the stock market. And, when I hit a period of crisis professionally, that's when I realized that that path would take me another 20 years to get to financial freedom. And the only true way to accelerate it without increasing your risk is by shifting your asset allocation, right? And so that's one of the core concepts that we talk about, that we focus on, and it's to get you to the point where you have significant exposure to alternative assets like real estate, conservative opportunities where you're lowering the overall risk in your portfolio while increasing your returns while being tax efficient. And that's our goal, right? That's our goal. That's why we bring you opportunities like this. And if you look at our portfolio, it's primarily heavily weighted towards multifamily investing. We do have self-storage and manufactured housing in the portfolio, but the reason we really hone in on multifamily is because of the fundamentals, right? This is one of those asset classes, the niches where the fundamentals are strong. We are across the country. We are in approximately 4 million unit housing shortage. Supply is decreasing significantly. 2026, we're seeing the lowest supply we have in a few years. Affordability is at its worst. Interest rates are where they are. Home prices are elevated, and there's a huge gap between renting and people paying mortgages, right? And so it makes sense for most people to rent in this environment. All of those things really make multifamily and essential housing a strong asset class to be investing in, right? And take that and go be the ability to go in to partner with really efficient boots on the ground operators where we're able to add value to these properties, force appreciation without waiting for market prices to go up. That's the business plan. And with all of this, while we're investing in these inflation correlated assets, where the environment we're in with tariffs the way they are, and with governmental policies, if we have a period of high inflation, you're going to see rents go up, and that's what's projected for the next few years, right? So you'll see rents go up, you'll see asset values go up, and our goal is to invest in these assets while also being super tax efficient, right? And so you're tax efficient in terms of the income that hits your bank account, right? And when we're structured correctly, you are not paying taxes on the cash flow that hits your bank every month, your bank account every month, and that's because of depreciation losses. And we're also efficient on the back end, right? Our goal is to be able to grow that wealth over time efficiently, and so the fundamentals are really strong for multifamily, which is why we love it. I mean, if you actually even look at, and this is across the country, right? Where we talked about the housing shortage, we talked about how it's so much cheaper to rent right now than it is to own. And then these numbers are very similar for the Houston submarket we're looking at today, right? And so the preserved Copperleaf, the preserved Copper Springs, the submarket we're looking at, average monthly rents are 1,500, and if you look at the home prices over there, which I think average home price is about $340,000, the average mortgage for people over there is $2,800, right? It's a huge discrepancy in terms of what it costs to rent versus what it costs to own, and I mean that's why it still makes absolute sense to get into these markets, into this asset class, right? And so for those of you who are new to the community and haven't had a chance to download our guide, I highly recommend downloading this. This is a free guide that I spent months working on. I call it a labor of love. And if you're completely new to real estate investing, completely new to syndications, or even if you've done this for a while, right? I love this because I took the time to build this for people who are starting. So you know how to build your own buy box, you know how to do due diligence, you learn how to vet the market, vet the individual deal, and know how to pick the sponsors that you want to work with. There's a due diligence checklist in it. And so all the tools you need to feel confident as you make these decisions, because my goal is to empower you to be able to really do this due diligence for yourself. So please make sure you download the guide. It's a great, valuable resource for those of you who really like to know what you're doing, and to understand things. And so I talk about metrics like IRR and really simplify those concepts. So when you show up to webinars like this, once you've gone through it, and it's an hour of focus reading, you're really able to understand everything, ask better questions, and do your own due diligence. Okay, so definitely lean into that. That being said, for all those of you who are part of the community, again, I really want to thank you. GW Gives is our charitable mission, and all of you make it possible. And I thank you for that. With that, let's get into this specific opportunity, right? So you may hear me. I just said Preserve at Copperleaf. That's a sister property to the Preserve at Copper Springs. That is right down the road. It's a property that was acquired in 2024 by our partners, and within 30 months, they did a cash out refi. 45% of invested capital was returned to investors. Now, I'm not saying that that's the business plan for this opportunity, but it just goes to show you what the strength of the submarket is. We've already executed a similar business plan in this sister property. So just goes to say that it talks about the strength of the property, the business plan, the operators we're working with. And so if you hear me slip up, that's where that's coming from. But let's talk about the Preserve at Copper Springs, right? And just before we get into, you'll hear me after this go into, hey, let's talk about the return profile. Let's talk about the risk profile and everything you need to know. But before we do that, I'm going to give you a quick overview, right? So when I look at this opportunity and I think about, for me, what the highlights are, that's what I've summarized over here. And so when we take a look at this opportunity, and if you want me to pick out like the top 5 things that I love about this, one of the highlights is the basis we're getting in. So we're getting the asset at a $2.5 million discount. So that's built-in equity for us as we enter the opportunity. The seller is being forced to sell the asset because of loan maturity, and we have our partners have an established relationship with the seller, which allows us to get in at a great basis and allows us to get this discount because our partners on the ground, boots on the ground, they have demonstrated their ability to close on these assets, right? And in a market like we're in, with the transaction volumes where they are, with interest rates where they are, that really, really matters, right? So love the fact that we're going in at a discount. Now, again, like I mentioned, we have an asset, a sister asset right down the street where our partners have executed the business plan, right? So there is a huge economies of scale. Lone Star Capital is our partner in this opportunity, and in a 10-mile radius, they own 1,400 units. What that allows us to do is it gives us economies of scale, right? And so they're vertically integrated, and we're able to share resources across the properties, which allows us to go in an economy that we're in without dumping a ton of capital into the asset to rehab the property and bump up the rents and thereby bump up the asset value. We're able, the business plan is to increase in net operating income, which is income minus expenses, by about 20%, right? And the plan is to do that without rehabbing the asset by increasing, other income, right? So by increasing, by tweaking, other ways, amenities, and adding amenity fees and tweaking little things to increase the income. But a big part of this NOI bump is going to be from expense, from reducing expenses and becoming increasingly efficient over there, right? And that comes from the fact that we own. Our partners own 1,400 units in a 10-mile radius. And so that's important for the overall business plan. For those of you who are from Houston, you will understand the significance of this. But I think the location is key. So when we're looking at a submarket to get into, one of the big things you're looking at is job growth, population growth, and migration into the submarket. And those numbers are really, really strong for the submarket we're looking at, right? So this asset is 15 minutes from both Apple and NVIDIA are building AI supercomputer factories 15 minutes, within a 15-minute driving distance from this asset. And they're slated to have over 3,000 new jobs in 2026 related to those factories opening, right? So when we're looking at demand supply dynamics, this feeds into the demand part. And even from a supply perspective, right? This is one of the submarkets in Houston that has the best absorption. It has within a 3-mile radius, there's zero supply. For those of you who have been investing in syndications in multifamily for the last 3 years, you know that one of the biggest pain points, one of the biggest factors affecting rent growth and occupancy in multifamily right now is supply, right? So some submarkets are really getting hit with a ton of supply, which is limiting our ability to bump up rents, right? And which is why it's really, really important for us to be able to take a look at both supply and demand. And when we look at demand drivers, that's where all these jobs created become super critical. When we're looking at supply drivers, it's important to understand a submarket's, supply and absorption. And the numbers are very, very strong for the submarket. And so that's important from, okay, a market perspective, business plan perspective. Something I really, really talk about a lot. And if you've been on these webinars with me, you'll know that we're hyper focused on finding assets that have significantly high cash flow day one, right? You'll hear me talk about DSCR. We'll talk about that later. And the reason this is important is that if you're looking for a single metric which talks about the health of the asset, and that's going to be day one cash flow. So this is not about what the projected cash flow is as we hold the asset over a year. This is about going in day one, knowing what current income is without us really tweaking anything, knowing what day one expenses are, which is typically higher than what it is for the seller, right? Because some things reset, like property taxes. Knowing that, what is it going to look like from a cash flow perspective day one? When you have high day one cash flow, that is a really strong way of assessing the health of an asset because it allows us to, even if there's variability, this allows us to go in and actually hold onto the asset, right? So this is another asset with strong day one cash flow. And a big part of that comes in from the discount that we're getting. It comes in from healthy occupancy. In-place occupancy is close to 95%. Delinquency for this property is 0.4%, right? And so healthy numbers, a great debt, all of that allows us to have significantly high day one cash flow. Given the interest rate environment we're in, and given where we are in the market cycle with asset values, it's not very often that you come across assets with such high cash flow, right? And so, for those of you who are new, this is one of the strongest metrics I think that talks about the health of an asset. And in this asset, average cash on cash returns are going to be about 6%. Like I said, that's going to be tax efficient over time, but day one cash flow is very, very healthy, closer to 4%. Okay, guys, for those of you who are on here, can you just check and make sure you're muted so we don't get interrupted? And then on the back end, we'll have tons of time for Q&A. But apart from that, what we've done in the last 12 months is we've been very intentional about going into assets where the business plan is not to go in and rehab assets and then bump up rents. It's been to go into assets where we're looking more at creative ways of adding value. Okay, in multifamily, we're not waiting for market values to go up and down to increase the asset's value. The plan is to go and increase that net operating income. And there are many ways to do it. Where in this particular case, the plan is to, a big part of that business plan is operational efficiencies, right? And another part of that is bumping up other income, not necessarily rent, which so through other amenities that we're adding. So it's essentially a core plus strategy. This is a newer vintage asset. It's a 2003 asset. It's a core plus strategy. Is just a lower risk strategy that is curated for the current economy, right? And so that's why we love it. I feel like I'm going into so much specifics, but that's an overview of what to why we love this asset, and then we'll go into details as we go through it. Okay, perfect. That being said, let's talk about returns quickly, right? So we talked about like everything we talked about is what we look at as operators to de-risk the opportunity. But let's talk about the return profile first, so you understand what this would look like potentially and how we're projecting what we're projecting returns to look like. Now, when you see us, and you'll see this in our emails and our SMS, and we'll say, hey guys, GW investors are getting higher returns than retail investors. And we're able to negotiate that. What we're doing is our investors are getting 9% preferred returns as opposed to 7% for retail investors. What does that mean? What do preferred returns mean? Now, there are two ways to look at cash flow. So with this particular project, average cash flow, that is the money that hits your bank account over time. It varies between 4 to 7%, right? On average, around 6%. Now that's what's hitting your bank account every month. That is tax deferred because of depreciation, and that's great. But our goal is to get you to 9% returns for every year that you're in the project before we even talk about profit splits, right? So this is what we call preferred returns. So after investor capital is returned, whenever we have a capital event, whenever we either sell the property or refinance, investors get their capital returned first, and then our investors get preferred returns, right? So for every year that you're in the deal, you caught up for 9% returns. So if you're getting 6% while you're in the opportunity, you're accruing 3% for each year that you're in the opportunity. You get caught up for that on the back end. And then the profits are split between the operators and our investors, right? So the profit split to operators does not get calculated till our investors get a 9% return for every year that they're in the opportunity. That's what preferred returns mean. For retail investors, Class A retail investors at 7%, we've negotiated a higher preferred return for our investors. So that's just part of it, right? In addition to that, retail investors get a 70-30 profit split. So after investors get their capital returned, preferred returns are calculated for every year that you're in the deal. And then what's left behind, that's considered profit, and that's where the profit split comes from. So as a Class A investor, you're getting a 75% profit share. Retail investors get a 70% profit share. And then the larger your investment amount is, you start getting into higher economics. So Class B investors get a 9% pref. They get an 80-20 profit split. Retail investors get a 70-30 profit split as a Class B investor. So this is again, it's a higher split, so it's higher enhanced economics. Class C investors get a 9% preferred return and an 85-15 profit split, right, as opposed to 80-20 for retail investors. And so in every category, our goal is to get our investors higher returns than retail investors. Okay. And so for those of you who are looking to see, okay, well, if I invest X amount into the opportunity, what is my annual cash flow going to look like? What is my profit split going to look like on the back end? That's what this slide is for. And if you want to take a look at this should be on our on the website, gwcapital.com/Houston5 in lowercase. But if not, there's a slide deck on there also, and you'll find that's in there if you want to take a look at this. But that just tells you what to expect. Now, again, remember, guys, these are not guaranteed. These are projected returns. It's important to keep that in the back of your mind if the business plan is executed as planned, right? And so, again, this is another way for those of you who are used to seeing these metrics, and we usually try to give you these metrics, right? So if you're saying, okay, I'm a Class A investor, what are my returns looking like? And you'll notice that the returns are improving across the classes. We like to also express this in a different way, right? So let's just talk about a Class A investor investing 50K, right? The goal, an equity multiple is what happens to your dollar amount, right? Over the hold period. The period for this particular opportunity is a projected 5-year hold period. So our goal is to almost double your capital over that 5-year hold period. And that's what equity multiple is. And average annualized returns, AAR, is, so if you're doubling your capital, that's close to a 20% average annualized return, right? So that's where this number comes from. If you're comparing real estate returns to the stock market, I would say this is your best metric. IRR is a metric that helps you compare two real estate investment opportunities. It's internal rate of return. It is a metric that is similar to AAR, but it factors in time value of money. And so the reason this differs between projects is if you have if you have the bulk of your capital returned up front, then your IRR is higher. If you get the bulk of your capital returned on the back end, your IRR is lower than your AAR. And so it just tells you how that the return is split across the timeline of the investment, right? And so if you're comparing two different opportunities, then this is a good metric to use to compare it. So hopefully I've explained this well. And if you have more questions, guys, feel free to drop it into the chat and we can talk about it on the back end. Again, the distribution waterfall, all of this is in the slide deck. If anyone has questions, we can go over it. But we talk about returns, and you'll hear me say this over and over again. When you're looking at two separate opportunities and you're comparing them, you need to make sure it fits your buy box, right? And that's the guide is a great way to figure out the gwcapital.com/guide, how to figure out your buy box. But I always say this, you can't just compare returns between two opportunities. You also have to compare the risk profile, right? Because any opportunity you're looking at, you have to look at both returns and risk. And so what we're going to do next is your typical due diligence, which you should be doing for all opportunities that you're exploring. And when we talk about risk assessment or due diligence, I like to break it into three separate segments. The first one's going to be market due diligence, right? What are the numbers? What are the demographics for the submarket? And what is the strength of the submarket? Then we'll talk about the property per se, and then we'll talk about the business plan, right? And so when you've worked on all three things, then you have a fair idea of what the risk return profile looks like, right? So it's always a combination of risk and return. Okay, so if we're ready, let's move on and take a look at what the market looks like. Quick tech check. Adrian, just want to make sure everything is clear on all platforms. I'm gonna take a sip of water.
All good?
Awesome, guys. I feel like when I did the highlights, I kind of went into a little bit of this, but let's talk about it, right? Why do we love the submarket? Like I mentioned, we have a sister property that our partners own down the road where they've executed the same business plan, right? And so we know what the strength of the submarket is. But this is, the Preserve of Copper Springs has great connectivity to the US 290 corridor, and it's connected to the energy corridor. It is close to those tech hubs that we were talking about, right? Apple and Nvidia's new factories with the greater than 3,000 jobs projected over in 2026, and so. Great connectivity to a lot of, you are always looking for industry diversification, right? So great connectivity to a lot of employment hubs. That's important. Like I mentioned, when you're looking at submarkets, you're looking at population growth, you're looking at job growth, you're looking at migration. But in this economy, especially, we're also looking at what supply in the submarket looks like. That is really important because it's going to affect occupancy and rent growth. And we're looking at supply and we're looking at absorption numbers, right? So as supply keeps hitting the submarket, how quickly are those units absorbed and what is occupancy in the submarket looking like? And this particular submarket has really, really strong absorption, almost twice that of the rest of the Houston submarket. And that just goes to say that there's a lot of migration happening there, and there's tons of job growth, and the demand fundamentals are really, really strong. Great school district, that's something we're always looking at. There's a high school within walking distance. And it's also a well-rated school district, so that's something renters are always looking for. We talk about supply constraint. There is no new supply within a 3-mile radius, which is critical. We also like to look at the population, right? The median household income is something to look at, and what that goes to show is do the renters have the ability to make their rent payments? And if we bump up rents, are they able to still continue to make those payments, right? And so the average household income within a 3-mile radius is approximately close to $120,000. Now, for those of you who have been in other opportunities, you know this is a really, really high number. Usually, anything that is close to 80,000 is considered pretty strong for a renter base. And so this is again just goes to show you the strength of the submarket, and we love seeing those numbers. Yeah, it's much stronger than we even need it to be, and so that's great. And so that's a lot about the submarket per se. The Houston market overall has great job growth, population growth, and a great affordability dynamics. But when we're looking at these assets, we're not specifically looking at the overall Houston markets. It's really, really important to dial in and take a look at submarket numbers, and that's what we looked at before, right? That being said, I probably have a few points over here that I wanted to go over. Now, we did talk about this previously. We talked about affordability. If you were to rent in this submarket, I'm sorry, if you were to rent, your rents are on average around 1,300. And if you were to buy and own property over here, average home price is about $340,000, which is pretty low for the rest of the country. But it's still in a mortgage payment in current interest rate environment close to $3,000. So there's a huge gap, which again, just it drives up the demand for rental units. And so we love that. We talked about connectivity. We talked about school districts. We talked about it being the number, I mean, didn't specifically mention this, but it's the number one submarket for absorption in Houston in the last 12 months. And so, yeah, the supply demand dynamics is something we're looking at very, very closely, especially in the current economic environment, depending on the part of the market cycle we're in, right? Okay. A lot of this data is also available in the slide deck. So if anyone wants to go and take a look at it, it's available to you. We talked about job growth and migration in Texas per se, especially in Houston. And we know based on the numbers that even in this particular submarket, those absorption numbers just show you that there's a lot of job growth and migration happening. Okay. And so that's essentially what we're looking at. And you'll see this over and over again, right? Whenever you're looking at market, submarket demographics, that's what you're looking at. You're looking at population growth. You're looking at job growth, migration. You also are looking at median household income, right? So strong numbers over there. Let's move on to this particular asset. What does the asset look like? Why do we love this? We talked about the basis. We're getting it at the $2.5 million discount, which means going in, we have built-in equity, right? And then a big part of that is because of the seller's loan maturity and our established relationship with the seller. Our partners have had about 134 million in transactions with the seller, which allowed us to get that discount. Now, the asset per se, the units are in great condition. They really don't need to be renovated at this point, and I'll show you some pictures. But also, the sellers have put in over $1 million of capital improvements since 2022, which just means there's not a lot of deferred maintenance, so not a lot of unexpected expenses that we need to hold reserves for. Again, especially in a market like this where we don't know what's happening with labor cost, right? We don't know what's happening with tariffs and construction costs. It's always we're always looking for core plus assets where there isn't a lot of deferred maintenance, where there isn't a need to dump capital into the assets and renovate them. And so it kind of fits the business model we're looking at in this market cycle. Strong in-place performance, occupancy is something we're looking at. Occupancy's been close to 95% over the last 12 months, which is great. Again, if you know, each submarket has different numbers, and although historically 95% occupancy is a strong number for most multifamily assets, we've seen assets, at least in the last few years, with a lot of supply hitting the markets, we've seen those numbers be in the low 90s typically. And so this just shows you, again, it's a testament to the fundamentals of the submarket, right? Again, operational scale, we talked about this is a big part of the business plan. Our partners have about 1,400 units in a 10-mile radius, which allows us to to have expense efficiencies, and that's something that really ties into the business plan where we're trying to be creative with value add, where expense management is a big part of the business plan. If you are in other assets we have in Houston, you'll see that when we send out our monthly reports, typically our expenses are much lower than what we even have in underwriting. And given our economies of scale over here, we're hoping that that's that we're able to achieve the same with this asset. But let me just make sure I don't miss anything important. We'll talk a little bit. So many of you know what break-even occupancy is. We talked about occupancy of this asset. Delinquency is close to 0.4%, which is super low, right? And it just tells you about the health of the tenant base and also management and how efficiently they're functioning. But what I want to highlight over here is break-even occupancy. And what does that mean? Break-even occupancy is how much occupancy needs to drop before we're not able to make mortgage payments. And ideally, you want this number to be below 80%. What we're seeing over here is that occupancy needs to drop to under 70% for us not to be able to make mortgage payments. So that again is just shows you the health of the asset. And it kind of it's another metric that kind of ties in with day one cash flow, right? So when you have such a strong break-even occupancy, you know that the asset is significantly cash flow positive. Excuse me. And that's what we talked about, right? So on average, cash flow is expected to be around 6%, and that's pretty high for the economic environment we're in. Now, in place rent, we talked about it. And what I want to highlight over here is pro forma rent is not that much higher. If you look at it, it's about $20 higher. And what that is again highlighting is the fact that the business plan is more about optimization than about going in and renovating. And so what you'll notice is that in the current economic environment with the market the way it is, it's not really easy to go and bump up rent significantly, right? A $200 rent bump is probably not sustainable, just where we are in the market cycle. And so you know that that's not what we've planned for. That's not what the underwriting is. And that just shows you how conservative the underwriting is, because that's something you really want to be intentional about, especially in this market cycle. Okay. Um, and so I also talked about our sister asset, which is down the street, where our partners were successfully able to navigate a cash out refi within 13 months of ownership with a 45% ROI return to investors. Now, that is not the business plan for this asset, but it talks about the strength of the submarket and the strength of operations that we have in the submarket. Um, Okay, so we can skip all of this. I'm going to talk a little bit more about the numbers later on, but just to give you an idea of what the interiors look like. So black appliances, granite countertops, really, top notch. Does not require a lot of updating. In unit washer dryers, and so all of that just commands higher rental premium. Amenities, that's something. So great clubhouse, a fitness center, covered parking, pool. This is almost required at this age. I mean, it also talks about the vintage of the asset, right? So this is a 2003 asset, and it just de-risks the business plan overall, getting into newer assets, right? So it gives us the ability to get into an asset. So we do love those early 2000 assets because you're getting into an asset that is still institutional quality, where you have a lot of options on the back end as we exit. But it's also something where you don't have a lot of deferred maintenance. There's not a lot of risk in terms of like you have with older assets, 1970s assets or even 1980s assets, where things can break down. Quality of construction, energy efficiencies are things you need to factor in. So it's that sweet spot where we like to be, especially when we want to be really conservative about the business plan. So with that being said, let's deep dive into the business plan. We talked about some of this before, but a big part of this is expense optimization, right? So the goal is to have a 19, close to 20% increase in the net operating income. But a big part of that, some of that is from revenue optimization, right? So bringing in value trash, bulk Wi-Fi, and executing an amenity fee, which bumps up the rent a little bit. But a big part of it is going to be cost savings, right? And expense optimization, because we have economies of scale. And so the highlight over here is that it's a conservative core plus strategy. I think I have a slide to explain a core plus versus value add strategy. And I think it's an important concept to understand. And some of that has to do with where you guys are in your investing journey. If you want to be conservative, then a core plus asset is a great place to be, where you're getting great returns, but you're not assuming as much risk. But I think apart from where you are in your investment cycle, another important thing to look at is where we are in the market cycle per se, right? With tariff uncertainty and with immigration policies the way they are and not knowing where labor costs are going, we prefer being in assets like this, core plus assets, where the business plan is more optimization than anything else. And so this is in line with what we've been looking for. It's similar to the other assets we've entered recently, where the goal is to value add without really going in and doing massive rehabs. And so. Let's see. I'm making sure I've gone through everything over here, but that that's the biggest highlight about the business plan. That's why we love this. A big part of the business plan is also debt, right? And so you always want to take a look at debt. When we look at debt, we're looking at a few things. Having fixed interest rate is important. We're getting fixed interest rate at 5.3%. It's a 7-year loan term, and the first 5 years are interest only. So it gives us enough time to execute the business plan, enough time to time our exit. That's going to be critical. And then the loan to value, for those of you who understand this, is 65%, which means we're putting a 35% down payment, and it's not the most leverage, but it's conservative leverage, and that's what we like to see. Especially in this market cycle. Okay. That being said, we talked about all the little ways we're planning to add value, right? Valet trash, and then amenity fees and bulk Wi-Fi. But a big part of the business plan is that expense optimization. So, we worked with this team multiple times before. This is what I want to talk about. And some of you may have seen the slide before. And when you go over the guide and you try to build your buy box, you're going to see this, you're going to see this concept introduced over there. But just to quickly talk about this, as an investor, you're taking a look at risk profile, all right? You're looking at returns and risk. And so this slide actually, portrays both of that, right? When you look at risk return profiles, new development's always going to have higher returns, but most risk, right? Because there are a lot of variables over there. And then on the opposite end of the spectrum, you have core assets, which are, let's say, it's brand new assets that don't have a ton of cash flow. The returns are going to be lower, but the risk is significantly low, right? Because there's not a lot of unexpected expenses that can show up over there. But in the middle, you have your traditional value add. Now, value add assets are where we would typically go in and we would renovate these assets, and that bumps up the rent, right? And then the bump in rent allows us to, it translates to an increase in the value of the asset. And that's your traditional bread and butter multifamily. Now, with the part of the market cycle we're in, and with everything that's happening in the economy, we are shifting more to core plus assets that have value add returns, right? So you'll see this asset is in that sweet spot where the returns are similar to your traditional value add, and that's because of that expense optimization, everything that we're seeing. But the risk is significantly low. The risk is that of a core plus asset, right? So 2003 vintage doesn't have a lot of deferred maintenance, doesn't require a lot of rehabbing to happen, but it's in that sweet spot, and that's where we like to be. And so I just wanted to explain that concept. I do see a hand raised, so if someone has a question that cannot wait till the end and you want to unmute, maybe we can take a question. But if it's something that can wait till the end, let's get through the presentation. Okay. Okay, guys. Rent comps and sales comps is something I want you to always be intentional about. This is something we take a look at. You always want to make sure that there's room for growth, right? And so the average rent comp for similar properties in the submarket is about $80, $70 higher than what we have for the Preserved Copper Springs. Preserved Copper Springs, the current rents are close to $1,500, and so there's room for growth. That's always good. We're always looking to make sure we're not top of that spectrum. Excuse me. Sorry about that. And then you also are looking at sales comps, right? And you can see that we're acquiring this asset at a discount on average per unit. Recent comparable sales are about $213,000 per unit. We're acquiring this at $163,000 per unit. So, and a big part of that is because of the discount we're getting, but this is something you want to be intentional about. Okay, I'm going to talk about the tax savings really quickly. Adrian, just keep an eye on the chat. If there's something where you feel like I need to be interrupted, like we can stop and we need to talk about it, feel free to unmute and let me know. But otherwise, I'll keep going in the interest of time. Now, tax benefits is I'm sure a lot of you have lots of questions about it, and we can talk about your individual situation on the back end. But what's something exciting that happened last year was that we got 100% bonus depreciation back, right? And that was part of the One Big Beautiful Bill. And why we love it as real estate investors is because, say, for example, just to explain this in numbers, right, is if you were to invest $100,000 into this opportunity, you can expect about Okay, I feel like I may need to pause and just make sure everyone can hear me okay and everything is going good. Jennifer, do you want to unmute or and is this something that we need to talk about? Adrian, can everyone hear me okay?
Yeah, we're hearing you fine, Pro.
Okay, perfect. I'm going to keep going then because I haven't had a chance to look at the chat. But we're almost close to the end, guys, and then we'll go into Q&A. But just to give you an example, if you were to invest $100,000, you can expect about $52,000 in passive losses, right? And so even though you're investing and you're getting cash flow hitting your bank account every month, on paper, you're going to get these losses for 2026. What that translates to is that the cash flow you're getting throughout the whole period of the deal ends up being tax deferred because of these losses, right? So you get the cash flow. If you're getting 10,000 in cash flow every year, that you don't have to pay taxes on it, which I think, in my opinion, is something we all need to be very intentional about, right? And it allows you that you have that time value of money now, right? So you're able to grow it tax deferred, and then on the back end, we have strategies where you can 1031 into the next opportunity, and we can talk about that. But this becomes really, really important, especially for those of you who have, say, exits from other syndications. These passive losses can be used against that. If you have other sources of passive income, you can use the losses against it. And if you have if you're someone who you or your spouse qualifies as a real estate professional, you can take these losses. You may be able to take these losses against active income, right? So lots of different things you can do with these tax losses. And like I said, a big part of really growing your wealth is being tax efficient. And this is just an example to show you how, over the course of time, over the course of 30 years, if you were to grow your portfolio while you're paying taxes in between versus tax deferred through 1031 exchanges, there's a significant impact on the amount in your growth. And so as real estate investors, I always say if you are getting income from your real estate portfolio and you're paying taxes on it, then there's definitely a way for you to be strategic about and intentional about making that tax efficient. And so we're excited. We're always excited when we have these opportunities. And then, can you use these tax savings? How you can use them? Some of you may be able to get more strategic with using these tax losses in year one based on what your portfolio looks like. And so that's a conversation worth having with your CPA. But for all of you, the cash flow that's hitting your bank account will be tax deferred, right? And that's something to take away. Now, quickly, is the deal conservative? We always do this, right? How have we de-risked the opportunity? And a lot of this is things we've talked about, right? We talked about debt. Debt is a big part of it. We talked about day one cash flow, right? That's something that's really, really important. The break-even occupancy that we talked about. The DSCR is debt service coverage ratio, and day one, our debt service coverage ratio is 1.35. Now you want it to be about 1.25, and what this means is that your net operating income, your income minus expenses, is about 35% more than your debt payment, right? And that's a healthy number. You want to be in that healthy area. You want to look at day one cash flow. Those are metrics I love to look at, and that's probably one of the first few things I look at to screen an opportunity before we start doing deep due diligence. And I want you to learn to do that also as you're exploring opportunities. Again, we got it at a great basis, and with the $2.5 million discount, the business plan, like I said, is a core plus business plan. We just talked about that, right? And that's something that we're being really intentional about. What is supply looking like in the submarket? We want to go into markets that are supply constrained. We don't want to see a lot of supply so that we can hit the occupancy numbers and rent growth that we're projecting. And then again, like we said, there's no deferred maintenance. The sellers have already put in $1 million into capital expenditure in this asset. And we talked about overall occupancy being strong in the submarket, having that experience from our partners owning other properties in the submarket again. So then we know how effectively we can execute the business plan. Yeah, so I think for this market cycle, it's a great asset. I want to quickly go over why we believe it's a strong time to invest in real estate per se. Now, my core belief is it's true for any investment, and this is true for how you invest in the stock market. I believe in dollar cost averaging. I believe in investing across market cycles. But that being said, if there's a time you've been waiting for a time to invest in the market, the right time to invest, then this would be a great time to invest because we are at the bottom of the market cycle, and this is where we have the most opportunity. We do tend to get outsized returns when you are investing and acquiring assets at a discount, which is what we're doing. Because of the market cycle, but also because of this particular asset with the discount we're getting upfront, right? And so if you're someone who's been waiting, then this would be a good time to invest. And this is just a graph showing what projections look like as interest rates drop. You're expecting, and we're going into a period where we're expecting inflation to be higher with tariffs. Multifamily asset values are going to pick up. We're seeing, the supply drop off significantly. All of this is going to lead to strong multifamily asset growth over time. And we talked about the fundamentals. We know that we're already acquiring discounted assets. We already know that we're in a period where housing affordability is at its lowest. There is a nationwide housing shortage. Construction is slowing. We are going into a pro-inflationary environment. Everything considered, the economy has stayed pretty stable, both from a GDP perspective and job growth perspective. And we do anticipate as rates keep dropping, multifamily asset values will increase. So strong fundamentals, and we're bullish on multifamily given the current market cycle. Information about our partners is in the slide decks. If you want to take a look at it, please go take a look at that. Their track record is on there also. In terms of next steps and timelines, this is a 506c. GW Capital Fund 1 is a 506c fund, and so only accredited investors can invest with us, which means you need to have at least $200,000 of income as an individual in the last 2 years, or $300,000 as a couple of joint, right? So joint income over the last 2 years, or net worth exceeding $1 million, which excludes the value of your primary residence. And so this could include retirement accounts and other assets that you own, right? And so you do need to be an accredited investor. If you have never filled out a form and you're wondering how you would get accredited, you can do that on our platform. It's very easy. It's integrated into the platform, so it takes less than 24 hours. But in terms of timelines, the soft commit deadlines, if you're trying to make a decision, and I will always say it's very hard to predict how quickly these opportunities fill up, especially because it's the first opportunity for 2026. I'd say we have strong demand already. And so if you're interested, please go to, and Aidan, if you can drop it in the chat for us, please, gwcapital.com/Houston5 in lowercase, the number 5, and then fill out a soft commit form. It at least locks your spot in, and then you have till the 18th to fund, and closing is going to be on the 13th. And if you want to book a call with the team and go over any questions you may have, you should be able to. Even if you can also drop a link to the book a call with the team, that'll be helpful for people. And you can hop on a call with me or Tommy. We can go over the opportunity and see how it fits into your portfolio, right? And that could be related to, does this fit my buy box? And also, how do I strategize around taxes with this? And so I'm always happy to have those conversations. That being said, let's get to Q&A, everyone. Let me see. I have a lot of the questions that we keep getting and conversations we've had with our investors in the last few weeks as we put this opportunity out. Let me quickly go over some of them, and then we'll get to the rest of the questions. GW Capital Fund 1, the reason we started this is because we wanted our investors to have preferential returns, right? So we wanted you to have higher returns than retail investors. It allows us to give you a single K1, which a lot of our investors like. You still get to pick and choose every opportunity you get into and how much you invest in it. And so it's completely customizable. It's a flexible fund. But we've worked really hard to have a significant reduction in costs so that doesn't get passed on to all of you. So we're still able to get diversification in there. We're able to get you higher returns and those tax efficiencies. But while we are enhancing your investor experience. Now, why are the sellers selling? The sellers are being forced to sell because of loan maturity. And that's why we're able to get a discount with them. Distributions for this particular asset, because we're closing in March, April will be the first full month of after acquisition. And so you'll see the first distributions for April and prorated distributions for March hit your bank account in May, and then it'll go on monthly from there. Detailed underwriting. So we will send you a video over, everyone, a detailed underwriting walkthrough video where we'll go over the actual spreadsheet for those of you who've done this multiple times who really like to look at the numbers, understand what the assumptions are. So we're going to get that to you. So keep your eyes open for that. The whole term is projected to be about 5 years, right? And now it could be shorter, it could be longer. And the factors that influence that are going to be interest rates, it's going to be our ability to execute the business plan, and which in this case really shouldn't take that long, but also market cap rates, right? So what is happening with the market? And those are the factors that are variables, but we're expecting it to be about 5 years. It could be three, it could be seven. And our for and which is why we have a 7 year loan term in the event that we so it gives us the ability to time our exit. Minimum investment amount is 50,000 for our investors. It's 100,000 for retail investors. And so again, um, we like to make sure we are, especially for those of you who are new and are trying to, you just want to test things and experiment it for yourself. The minimum amount is 50,000, and it's lower than what it is for retail investors. Can you use IRA funds? Yes, you can. I would always add the caveat over here that if you have funds outside of your IRA accounts, then investing in real estate outside of your retirement accounts is always the best thing because it is a tax efficient investment, and you don't want to use tax deferred dollars unless you have to, right? And so also when you invest through IRAs, may be subject to UBIT taxes. And so from both perspectives, if you have funds outside your IRA, that's great. But if you need to use IRA funds, because the majority of us have the bulk of our capital in our IRA accounts. And when we're talking about asset allocation, you really need to also have asset allocation within there. So if you need to use IRA funds, always feel free to shoot us an email at admin@gwcapital.com, and we'll connect you to our preferred IRA custodians. If you already have an IRA custodian, then you're all set. Okay. Do I need an LLC? I would say the majority of our investors invest in their personal name, and I do too. Oh, when I invest as an LP in all of our opportunities. And so I would say please consult with your attorney. There are a lot of our investors, some of our investors also invest through LLCs, and that may be because they want the additional protection. The LLC structure of the asset per se provides all our investors with limited liability, but there may be other reasons why you would want to invest through an LLC. So please have that conversation with your attorney. That being said, let me look at time. Okay, top of the hour. Not bad, not bad. Let's get to Q&A, guys. And so some of you have your hands raised. Maybe we can start over there. If you have your hand raised, let me see who it is. I think it was Jessica. Oh, interesting. Um, so anyone who has a hand raised can go ahead and take that first question. If not, hey Anthony, hey Anurag, Ashraf. I feel like I want to say hi. Hi Ben, how are you doing? How's Nina? Mary, Maureen still on here. Let's see, Omada is here. Hey Rick, Rishi. Uh, okay, awesome guys. Okay, I'm not seeing any other hands raised except mine. I have no idea how that happened, but let's get to Q&A. Aiden, can you drop all the questions from the other platforms in here so I can take a look at things? Awesome, thank you. Okay, Rick, hope you got the question answered for bonus depreciation. We said it's around 52,000, right? And so the numbers always get finalized after acquisition, but around 52,000. Preferred returns for our investors are 9% for Class A onwards, right? So A, B, and C is 9% preferred returns. So you got that. Here, Robert, your question is what is asymmetric risk return? And so that's the concept where you want to increase your returns while lowering risk, right? And that's always our goal. And so, like I mentioned, going into an asset like this, which is a 2003 vintage, the business plan is it's a core plus asset where we're doing creative value add, right? So that's lowering risk per se. That's where when I talk about what does the market look like, the market demographics, submarket demographics, the property, how are we de-risking in terms of debt and the business plan? We'll talk about all of that. That's how we're lowering our risk in this asset. And we talked about how we got the discount and how we're hoping to bump up NOI by about 20%. That's how we're increasing and boosting our returns. And that's a concept. You'll probably Ray Dalio talks about this also. And the more uncorrelated assets, so assets that are not correlated to the stock market that you have in your portfolio, that really helps you get to that peak asymmetric risk reward profile. So, uh, Hey, so the next question is why does it make sense to get into this asset class when the real estate price is higher than rents? And it's because for most people, especially for younger people, it makes sense to rent in this economy than it does to own, right? And so it increases the demand for rentals, which gives us healthy occupancy and healthy rent growth rates. Shouldn't we buy when home prices are lower? When home prices are lower and mortgage costs are closer to the cost of renting, again, there's slight shifts, right? But anyone who's able to afford to buy a home will prefer buying a home versus renting. With affordability being the lowest we have seen in decades, more people are willing to rent at this point, and that another factor that contributes to that is the housing shortage. It is interest rates being high, and that's why mortgages are higher. But it's also the economy, right? Whenever there's more uncertainty in the economy, people prefer to rent. But home prices being higher also make creates an environment where there are more renters inherently because it makes sense for most people to rent. Their expenses are sometimes half of what it would be if they were to own that home, right? And so that's why. What is the benefit for existing investors? Rick, I'm not sure I understand that question. So if you want to unmute and we can go over that. Hey, John, is there a penalty for early loan payoff? Yes. Prepayment penalty is defeasance in this case, but that starts, the closer we get to that 7 year period. So if you're in that 5 year period, then we start having more options for exiting. But the prepayment penalty is defeasance in this case. Thank you for dropping those links in there, Adrian. Hey, Ashraf, is there any tax deduction on W-2 income for the investment amount? Now, because the losses are passive losses. Now, if you have a combined, so there are a few scenarios in which the losses can be used against W-2 income, but for all other scenarios, the losses can only be used against passive income, right? So if you have other sources of passive income, be that from an endoscopy center, a dialysis center, a surgical center, or other rental properties, or even short-term rentals in year two, you can use the losses against that. You can use the losses against exits from other syndications, exit of other real estate, that is being sold, right? Because those are gains on the passive side. The only situations in which you can use the losses against W-2 income will be if you have an AGI, adjusted gross income, under $150,000, or which I think is not the case for most of us, right? Or if you have you or your spouse qualify as a real estate professional and you're hitting material participation, then you're able to move those losses into the active bucket. So a lot of our students, me included, were able to do that because we qualify as reps, or we have a spouse that qualifies for reps, and we also hit material participation. I hope that answers the question. Hey, Lobo, what is the seller's motivation to sell? I think we discussed that. They are hitting a loan maturity, and so they need to sell, and they need to sell and to someone who has demonstrated ability to close the deal. A lot of people are having difficulty raising capital in this environment. So you need to have a strong performance record and a strong relationship with the seller for them to trust that you're going to be able to, to successfully execute the transaction in a timely fashion. And then you're able to negotiate those discounts. And that's what we were able to do because our partners have had prior transactions to the effect of $134 million with the sellers. And that's why they were able to negotiate that. We're not assuming the seller's loan. No, not in this case because their loan is maturing. Hey, Regina, what is the anticipated monthly distribution? So if you remember the slide that I showed you, which talks about the monthly distribution, you can go take a look at it on the slide deck. If you go to the landing page, which is gwcapital.com/Houston 5. But just to give you an example, so on average, So it's anywhere from 4 to, I think it's 4 to 8%. So average is about 6%, right? And so the as we execute the business plan, the cash flow increases over time, right? So it starts at around 4%, which means for a $100,000 investment, it's $4,000 in year one, or on average at $6,000, let's say, right? That's an easier number, which means it's a $500 monthly tax-free deposit into your bank account for a 100K investment. I hope that is helpful. Okay, thank you, Adrian. Um, so, Regina, yes. So, if you are invested in multiple assets within GW Capital Fund One, say you get into the Preserve at Copper Springs, and then before the end of this year, you invest in two other opportunities with us, because it is a flexible fund. End of the year, you will get a single K1 for 2025, and once you get to the point where you have about 10, 15 opportunities, it just adds more complexity to have to download all of that. And it's easier when you have a single K1. Okay, and so Lobo, the question is, I think, which is the last question. Guys, if you have any other questions, we're a small enough group at this point where you can raise your hand and we can have the conversation. Let me make sure I'm understanding this question right. It says, are the buyers raising 35% private equity and 65%? Oh, so yes, we as the buyers, we're getting 65% of the asset value as a loan, and then the rest is capital that we're raising. Correct. Um, Interest rate is 5.3%, right? And that's a fixed interest rate. It is agency debt. And so that is safer debt than, say, bridge loans. Okay, guys, great questions, great questions. And then, as always, we're more than happy to continue these conversations and hop on calls with you to discuss your personal situation. So please make sure you're booking those calls. Aiden, if you can drop those links again in the chat for those of you who are on here. I'm going to stay on for another minute or so, guys. If you have any other questions, raise your hand and we can get to them. If not, let me just say hi to anyone I have not. Hey, Jeffrey, how are you doing? Vijay, Venkat. Okay, Monica, nice to see everyone. Okay, guys, Oddly, again, I'm here to support you. We may be doing another webinar later for any other, because there are more people who start showing interest, and you'll probably have more questions, but we're here to support you. And it was great chatting with everyone. Talk to everyone soon. Thank you, Adrian, Anthony, for your support. Bye, guys.
See you. Thank you.
Take care, Anurag.
Bye.
Bye.